Hello! Welcome to this week's Private Funds Update. I'm Sandra from SmartEsq. Here's what I learned this week. First up, the regulatory turf war over digital assets may finally be cooling down. The SEC and CFTC have just issued highly anticipated joint guidance clarifying exactly how federal securities and commodities laws apply to the crypto ecosystem. For years, private funds have navigated a minefield of regulation by enforcement. This new comprehensive joint framework finally establishes concrete lines. It introduces a specific functional test to determine when a digital asset transitions from a security to a commodity, clarifies the dual registration requirements for platforms trading hybrid assets, and sets unified baseline rules for stablecoin issuers. The agencies are acting in lockstep to signal that the gray area defense is officially dead. If your fund holds tokenized assets, stakes tokens, or invests in blockchain infrastructure, it is time to audit your portfolios against this new baseline. Sticking with digital assets, we also have groundbreaking standalone news from the CFTC. The commodities regulator has just issued its first ever no-action relief to a non-custodial crypto wallet maker, Phantom Technologies. This is a watershed moment for decentralized finance. By granting this relief, the CFTC is signaling a willingness to let non-custodial wallet infrastructure operate without the crushing burden of traditional clearinghouse and exchange regulations, provided specific consumer protection guardrails are in place. If your fund invests in Web3 or DeFi infrastructure, this no-action letter just became your new structural blueprint. Pivoting across the pond, the UK's HMRC has rolled out a sleeper regulation causing immediate headaches for private funds: the mandatory tax advisor registration regime. While it sounds like something targeting external accounting vendors, the rules are drafted so broadly that in-house tax managers at asset management firms, who provide guidance to their broader internal fund complex, may now be legally forced to register directly with HMRC. For global GPs with a London footprint, you need to review your internal tax function right now to avoid accidental non-compliance. Finally, as a reminder, the rollout for AIFMD 2.0 is fast approaching, but the timeline is actually split into 3 distinct phases that managers must track. The core rules, including strict new liquidity management tools and restrictions for funds extending credit, must be implemented by EU member states by exactly April 16, 2026. However, there are 2 major carve-outs. First, the new data-heavy Annex 4 regulatory reporting requirements won't kick in until April 2027. Second, if you operate a legacy loan originating fund established before mid-April 2024, you receive a grandfathering lifeline giving you until April 2029 to fully comply with the new leverage and concentration limits. Managers need to audit their fund vintages today to determine which of these 3 deadlines applies to their portfolios. That's it for this week. You can learn more about these topics from me on the SmartEsq platform. If you are curious about the services we offer, please visit www.smartesk.ai.